Welcome to yet another episode of Reinventing Finance. Happy New Year as well. So those of you can kind of look back at when we have actually recorded this. Tom, it's a pleasure to see you again. And Andrew, happy to have you on this podcast. As I've said, you know, good things come to those who wait. We've danced around a little bit for this in 2021, and happy to have you virtually in my, you can't see it, but in my living room.
Yeah,
how are you?
Pleased to be here.
Why don't we kick this off and, you know, why don't you just briefly introduce yourself to our viewers and listeners? Who are you and what the hell do you do?
Sure. Yeah. So I'm Andy Re. I used to be an insurance executive. I've been in the primary market, in the reinsurance market. I ran a consulting firm for a bit. I was chairman of an insurance technology firm. Then in 2015, I guess I was one of the pioneers for the corporate insurance sector's involvement in InsurTech. I built a vehicle for Munich Re called Digital Partners, which partnered with and invested in the very best of the InsurTechs. Because we were the first, and maybe because we had the most money, we ended up the biggest and partnering with most of the best. So we had quite a good ride. I left Digital Partners in 2020. When, as we agreed with Munich Re, they wanted to integrate it back into the mothership. So since then, I've been doing some independent, some investing, sit on the board of a couple of companies, and advise some private equity funds investing in the InsurTech space.
Awesome. There's a couple of things I'm gonna dig a little bit deeper, because I do believe that Digital Partners has pioneered. There seem to at least a lot of smart and fast, you know, followers after that model. But maybe before we kind of go into that more broadly, what's currently on your mind? What is exciting? What's frustrating?
Yeah, I think we're at a really interesting point now. It's probably a good job it took us a long time to get the date together, because it seems to me we are now at a real sort of inflection point in InsurTech, where you know, reality is beginning to bite. So you know, when we started Digital Partners in 2016, the insurance was really in the doldrums, right? We had a really soft market. A group like Munich Re had far more capital than opportunities. So in a sense, you know, we didn't have to put together a very strong business plan for Munich Re to go, okay, this looks interesting and we've got plenty of spare money, let's go and do this. Now in the current market conditions, I think you've got to be, you know, we're in a much harder market. We're in a market where you can make money out of traditional insurance underwriting. So if you want to do something different, you need to have a much better business case. And what we're seeing with the InsurTechs is that little by little they're realizing that you've actually got to make underwriting profit. If you're not profitable, then eventually this thing isn't going to work. And we're seeing even some of the golden generation struggling on that. But at the same time, you've got the incumbents who have been through COVID and have realized that all of their customers are buying digital and will continue to buy digital. You've had this secular change. I think someone from Adobe said that they had seen, they've been sort of seeing a steady transition of customers moving towards digital channels across a whole range of industries. And this channel had basically been uninterrupted since about 2000. And then what happened in 2020 was that they got 5 years worth of change in 1 year. And they saw no sign of it reversing or slowing down again. Basically, the world has just jumped ahead 4 years. So all the incumbent insurers, you know, even though they're in benign underwriting conditions now, looking at the future and going, gosh, our business model doesn't really isn't really fit for the future. So we're into this fascinating position where I think if you're an InsurTech and you've got your model right, then the future is amazing and has really accelerated. If you've got your model wrong, then you're going to struggle. And I think we're just at the beginning of seeing, you know, who wins and who doesn't. And I guess there's a couple of things that come out of that. One is we're starting to see the opportunity in small business and commercial. You know, those things are harder to get into. So they're slower, but eventually there's maybe more opportunity to make money there than in, you know, personal motor, which is just really, really competitive. And the other thing I think is we are still right at the beginning of seeing the growth of embedded insurance, where, you know, big retail brands are seeing the opportunity to use their brand to sell into insurance and to offer a much better customer proposition than the traditional insurers can offer. Yeah, again, both of those I think offer a real opportunity if you've got your business model right in the first place.
On that note, because just this morning I was walking my daughter to daycare, and I got this text message from someone, and he just said, "We're at peak InsurTech. InsurTech should just sell." I was like, I don't know. I mean, what do you? I mean, it's such a broad question, and, you know, there's so many different verticals. But what do you feel? You know, are we at peak, or are we at peak InsurTech? What does that even mean? Are we where are we on that journey? I know it's a very broad question, but I literally got.
Yeah, I mean, it depends what you mean by. It depends what you mean by.
Exactly.
Peak, you know. I mean, you know, are we at the peak of sort of, you know, technology's influence on insurance? Nowhere near. I mean, we're not even in the foothills yet. You know, you look at something like the Lloyd's Blueprint 2, and in 5 years, Lloyd's will look completely different to today, and in 15 years, you know, Lloyd's today will be completely unrecognizable. That, you know, the transition of technology into real world insurance, I think we are still in the foothills. This is a very slow moving industry, so, you know, we've got to be realistic, I think, about that. On the valuations point, which is probably what he was talking about, I think there's some truth in that. Andy Tam from Petronella Weinberg said to me that what they were seeing like 6 months or 9 months ago was essentially, you know, anybody with a good pitch was able to raise money. Whereas what they're seeing now is the best are able to raise money still at very steep valuations. But if you're not in that sort of golden top third or something, then you find it much more difficult to raise money from anywhere. Yeah, that's maybe what's going on there. I think if you're on top of your game, and in particular, if you've got a business model which is going to play well in the public market, then raising money is not a problem. But maybe some of the stupid or less well-informed money just chasing top line, some of that's probably gone. So
because you said, you know, to be ahead of your game, having your business model right, what does that mean for you? Because, you know, it's broad, right? Does that mean ensuring underwriting? Is that cost? Is that customer acquisition cost? Where do you think that some of the, you know, the golden boys and girls might have to adjust, or where anyone joining, you know, the fray now needs to just make sure, okay, the rules are somewhat different? Is it CAC? Is it underwriting? Is it admin? What is it? Everything?
Yes, it's everything, but to my mind, it's more underwriting, and then maybe some specific pieces of admin. it's less around CAC. I think the point is, if you're an NGA or a full stack insurer, then eventually what you're going to be doing, when all the excitement and the growth has worn off, then what you're going to be doing is you are going to be selling insurance at very large volumes and pretty small margin, because there is almost no insurance company in the world today that isn't that. And the reality is, this is a market which is very large but very competitive and has very low barriers to entry. So it is always going to be highly competed. So the bad thing about that is that you are going to operate on very thin margins. But the good side of that is, because the industry operates at such scale, if you have a marginal advantage over your peers, then you're going to win, right? So one of the companies I backed heavily at Digital Partners was Next Insurance. They're in US SME, and one of the reasons that we really doubled down on our partnership and our investment with them is we could see them beginning to generate underwriting advantage. They were using sources of data that the traditional industry, in some cases, didn't have. In many cases, couldn't analyze. For example, because it was unstructured data, website scrapings, Yelp reviews, and so on. And they were starting to eke out underwriting advantage from that, and really small figures, right? A few percent of premium. But they operate in a market where a good margin is like 3 or 4% of premium. So a few percent of premium actually means you're twice as profitable as the next one. And those kind of advantages, with the benefit of the scale of the US SME market, those kind of advantages really make a difference. It's interesting if you look at Lemonade. I mean, Lemonade have got the problem that the renters market is maybe not quite big enough to build a really big business, but Lemonade were able to get their underwriting into a profitable state through some smart technology, through using AI around claims fraud and so on, and we're able to do that without dampening their growth. Some of the other InsurTechs, I think, will find that hard. Some of the other InsurTechs, I think, on the underwriting side, the big question is, do they really have a competitive advantage over the market?
Fair enough. I thought what I find quite interesting, and I'm not sure whether I'm over-interpreting it, but what you've said with Next, when you said, we doubled down because they were able to show and face whatever after one to build underwriting advantage. So it would then mean that initially, you need to make sure that you build a book of business and then get the underwriting advantage. I mean, ideally you get both from the beginning, but ultimately you need to prove, right, that these additional data points value. Is that fair, that you say, guys, get a book of business that is big enough so you can then add underwriting advantage, but you really need to have reinsurers and capital investors that are patient, because you'll probably need to show this out over a few claims and renewal cycles.
That's exactly right. Yeah, I mean, what Next did was they collected that data from day one, and yeah, we were their underwriting partner as well as their investor, and we were very patient as they slowly began to bleed that data into the book, and that's a long process. It's an iterative process. They sit down with their underwriter. They say, look, we found this piece of data. There seems to be a correlation between this and claims. Do you think it makes sense? And the underwriter goes through it, and you get sort of bit by bit by bit. But the great thing is, once you've got one of those one of those structural advantages you're really difficult to compete against. One of my other favorites, one of those ones we backed, bought by many in the pet insurance space. Your biggest problem in pet insurance is the cost of paying claims. Your average claim in pet insurance is really small. It's like 200 quid. So your challenge is how do I efficiently assess claims? And I have to assess every claim, because otherwise, the vets will just add a little bit to the bill. Will add a treatment on that's not strictly covered, and all of a sudden my claims bill has risen 5%, 10%. If it's risen 10%, then I'm wildly unprofitable. And because Bought by Many have got a bit more data than anybody else, because they thought about this from day one, so set their systems up, set their data up to be able to do this, Bought by Many are slowly and surely beginning to automate the payment of claims. And that just gives them a structural advantage over the rest of the industry. And it's not huge, it's a few percentage points, but a few percentage points in a market, again, where what's a good combined ratio in pet insurance, probably 97. So if I can give you another 3 or 4% margin, then I've just doubled your profitability. And it's those things, I think, that are eventually the difference between a really, really profitable, really valuable long-term proposition and just another insurer.
Is it just in general not always the question of specialization? Let's say that the old world were national carriers doing more or less any type of product and any type of client segment, and then in a new global world we're focusing on certain products or target groups. Yeah,
I think there's something in that, Tom. Certainly, one of the things you used to hear from entrepreneurs, in sort of 2016, they would come along with a deck, and the sort of page one of the deck would basically say all insurance companies are stupid and useless. And when I saw a deck like that, I rarely turned to page 2, because you think, you can't really believe that the guy who runs Allianz or Zurich is stupid, right? That's the world doesn't work that way. But I think you can believe that the guy who runs Allianz or Zurich or Admiral doesn't really pay as much attention as he might do to the pet insurance business or the small business insurance business, because it's just not important to him. So why take a really sophisticated company on at what they're best at? Take them on at what they're not very good at. And the great thing about insurance is all these needs are massive, right?
And I think that's an interesting point. I was listening to a podcast. Again, I use the daycare route to listen to podcasts, or getting some weird SMS about the insurance market peaking. And I thought it was quite interesting, because I think there was one question for someone who I think knows a lot about digital sales. And what he said was that one of the specializations, so the question was, is he a generalist or a specialist? And he says, well, he kind of has to be both. But what he thinks a lot of his peers who might be a little bit older than him, on looking at details, on nuances, on digital processes, is the exponential impact of scaling. So if you have an onboarding process and you run it through agents, etc., there's the human impact and it's fine. And, you kind of look, it's more around incentivization, general thing. And you don't have to, it's no benefit from a general manager to understand that. But I think as you get into, it has nothing to do with digital sales, it's just with digital processes that scale, that there is a benefit also from, tinkering around it and fine-tuning these things, and then exponentially scaling, because all of a sudden you're running 100,000, 200,000, 500,000 use cases or interactions through such a process, which typically I would assume, and I think he's a really smart guy, but I don't think that's what Oliver Bete does, quite frankly.
Yeah, and that's so much easier when you're operating through digital channels, because you can see everything.
More information.
Yeah, and one of the lessons that we learned at Next, the Guy Goldstein came into insurance with he never knew anything about insurance. I think I became his friend because I was the only person who knew anything about insurance, but he did understand sort of how to build data on customers and how to understand what they were doing, and they would track how long the customer would take on any question. They would track the order in which customers answered questions on a screen, because it's a big deal. If you skip from question 4 to question 6, then there's something wrong with question 5. Either it's sensitive, or the customer doesn't know the answer, or it confuses them in some way, or they have to go away and find a piece of information. Either way, you've got to understand what's going on with question 5. One of my favorite stories from the early days of that was we were doing independent contractors, and one of our early products was photographers, so we had a question in one of the standard underwriting questions was, do you do an in-nude photography? A straightforward reason for that, because you don't want to insure pornographers in the US. A, there's a lot of risk. B, it's unsavory and sort of carries reputational risk. And C, you have got a potentially let's say dangerous situation which could result in lawsuits, and lawsuits in America are really expensive. So we asked this question. It seemed to us that this is a fairly straightforward question, and yet people take a long time to answer this question. They pause on it, they skip, they go back, they change their answer later. We're like, how can this question be hard? So of course, realizing that they were losing a lot of customers, far more customers than we expected, answered yes to this question and then got kicked out of the underwriting process. So they just put a box underneath. When you answered yes, they asked one. They just asked you just to put a bit of freeform, and then it just kicked you out of the underwriting process. But they're just gathering data. And what we discovered was that a lot of photographers either do or worry that they might take the odd photograph. So you're in there. I don't want to talk about you particularly, but you're in there having some photographs taken with your wife, and she decides she wants to do one topless or something, and they just assume this situation might happen. But we're like, hang on, this is not the situation we are trying to underwrite against. Yeah. So then you alter the question a little bit, and you say, is it more than a certain proportion, or are you being paid by a modeling agency to do this kind of thing? And lo and behold, instead of having 40% of people saying yes to this question, you have 0.1% of people saying yes to this question. And you just think, had we put that product out with brokers, the product would completely have failed. We'd have had a 40% decline rate, and we'd have taken the product off the shelf again. But yeah, with digital, you can just experiment and learn. And to me, it's all about really getting in. The underwriting is the meat of what we do. So you have to get into the meat of it and get into the meat of that, get into that data and understand what's going on and what's going on in your customers' heads.
I think that's absolutely right. I mean, I remember at uni, there was this term cash flow underwriting. I don't think it's that sexy anymore. So you gotta get your underwriting book in order. Is there any kind of surprises, hypotheses that were validated or falsified during your time at Digital Partners? Because I feel you had a unique vantage point at InsurTech, what works, what didn't, and probably I would have been shocked if you didn't have some form of learning curve during those years yourself.
I mean, yeah, we made so many mistakes. I would love to. I would love to have the time again.
Top
You
three.
know,
Top three.
absolutely. The one thing that I think that Munich Re did right with us, when I pitched the idea to the board, my one worry was that that Munich Re would find this kind of vehicle difficult to manage, because Munich Re, you know, it tries to control things. It likes to understand what's going on, and you know, and I was in the when I pitched the idea to Torsten Jeverek, who runs the reinsurance business, you know, I couldn't even write a business plan. I had a one-page sketch of what this business looked like, and so what I said to him was, you need to give us time and you need to give us space. So time, you know, I said I wanted 3 years, and I wanted an assumption that we could have another year on top of the 3 years, assuming everything was okay. With hindsight, we should probably have said 5, because it takes longer really to.
It's not enough 3 years.
Yeah, if you look at the how much the value of the business went up between year 4 and 5, because year 4 and 5 was when all of those companies we backed started to go public. You know, so we suddenly have the $5 billion exit for Hippo, for example. You know, Nick's raised at $4 billion, Bottomini raised at $2 billion. So all of a sudden, you know, we were really monetizing sort of just after the 4-year point. But what we did get right was, I said to Torsten that you know, you have to buy us space, so you need to tell all the central departments that they can't have what they want. We're not going to follow their processes. We're not going to do things their way. You need to tell them to help us. And he actually went further than that. He had it was in the balanced scorecard of all the sort of central departments, you know, help digital partners. I remember the head of procurement, group procurement, saying, you know, how can we help? And I'm like, well, you know, you could leave us alone. It's like, okay, you know, we'll just leave you alone. And then a little bit later, I had a procurement issue. And so I called him and said, look, can you solve this? And the level of service, you know, you've suddenly got an expert who sees it as his job just to help you, not control you, just to do what you solve the problem that you're sort of presenting with. And that was amazing that we had the group chief underwriter as our chief underwriting officer, which was just incredible to be able to access that kind of expertise and have the freedom to use it the way we used it. One of the big lesson on the finances is that we set out from day one knowing that we would try and make money on the equity investment side and on the underwriting side, and we thought we would make more money on the underwriting side and less on the investment side. The reality was we were wildly wrong about that. We made, I mean, a couple of billion on the investment side and not much on the underwriting side. And so with hindsight, we'd have probably restructured some of what we did with the partnerships, and in particular, some of what we did in terms of how we valued the business, to take the eye off the underwriting side a little bit and put it more on the investment side. But you know, eventually, it was a great experiment. It was great to see, as I was hanging up my boots in digital partners, that everybody, all of the other big reinsurers and a lot of the large insurers were sort of coming in and copying our model. That was a nice vindication for us.
But it's still very, very interesting, because let's say InsurTech was invented, let's say, very late if you compare this with fintech or other spaces. So in the end of the 90s, there already were, let's say, those ideas. I mean, then it was more or less blocked by all these insurance companies and the reinsurance companies who didn't want to compete with the normal insurance companies. But it was not, let's say, totally new to the space, because those business models were already there on the fintech or on the banking side. So what I find very striking is it took an enormous amount of time before one of the reinsurance companies started, and Munich Re was the first, and then finally all the other ones were joining. So what do you think the reason was for that? Is it this kind of kind of dominance of the whole industry, and then watching each other and being afraid of harming their own clients? Or
yes, maybe a bit. I mean, I think the insurance industry was a cozier place in the 90s. You know, if you go back to the 90s, you know, you still had cross shareholdings between insurers and reinsurers. That that sort of symbiotic existence had ceased to exist. There was also, I do think it was also a point in time. You know, I think InsurTech started or started again because of the wave of fintech. You know, one of the things that dragged me into InsurTech was looking at what was happening in fintech in 2015, when, you know, you'd got this next wave of neobanks and other fintechs suddenly starting to raise serious amounts of money from East Coast investors, not just sort of West Coast tech investors. You know, it was that persuaded me that there was a real opportunity here. I don't think it was that persuaded Munich Re, though. I think Munich Re were more looking at themselves, and you know, they'd been in a soft market for several years. During that soft market time, there had been some significant catastrophe events. I mean, the Katrina season, one of the worst hurricane, possibly the worst hurricane season they'd ever had. They'd had the Fukushima event. They'd had the New Zealand earthquake back in 2011, and none of them had really hardened the market in the way that it used to. And I think there was a sense in Munich Re that that capital was flowing around so quickly now. Capital is so fungible that old nice world where you have some lean years and then you have some fat years and then you have some lean years and some fat years, that nice cycle was now broken. And if that cycle was broken, then that meant two things. Firstly, you had to find new sources of revenue while you could, you know, while you had assets and earnings to support the investment. And secondly, the idea that you don't compete with your incumbent clients was now dead, because your incumbent clients were not allowing you to make enough of a margin to sustain yourself. So that was, you know, in Munich Re at the time, there was definitely a sense of that any good idea was going to get backed, because they were in this situation of being relatively earnings rich, but looking at a lean future.
Any other kind of mistakes or learnings from digital partners that you found instructive? And if you said no, you know, that's it's fine. I just feel it's you've been exposed to such a kind of unique time and company window. That's why I just want to kind of dig.
Sure. I mean, I think we sort of some of what I said before about compete where the incumbents are not so strong. Focus on marginal advantage. A lot of that really came from learning in digital partners. One of the things that we backed early on was propositions which required the customer to care what they were buying. So, you know, sort of micro propositions, turn on, turn off kind of propositions. Those things just didn't work at all. In a way, I suppose we started, you know, wide-eyed and naive and ended up like cynical insurance people again. The reality is customers always have better things to do than buy insurance. It's almost always going to be a low-touch product. you're almost always going to have relatively low brand value. So you've got to, I think, be realistic about, where you get your competitive advantage from. Again, using the example of Bought by Many, they do have an extraordinary loyalty advantage with their customers, and they have a group of customers who really value them as a brand much more so than, frankly, any other insurance business I've ever seen in my entire career. And yet what we learned over 5 years working with them was that loyalty advantage stretched to pet insurance and not beyond pet insurance. So we tried all sorts. We tried to sell them home insurance and renters and motor insurance, and these customers who were incredibly loyal for their pet insurance still went to aggregators and other channels for all of their other insurance. So there is no Apple brand out there, which makes the embedded insurance. We didn't do enough in embedded insurance. I think we missed a trick there. I'm fascinated by businesses like Cover Genius, for example, because what they're doing is basically saying, look, insurance is in a way, insurance is never a product in itself. Insurance is a byproduct of something else that you're doing or something else that you own, and the insurance is never going to be the most important part of that. If you buy a mortgage from Tom, then what matters is your mortgage, or possibly the house that you're buying, in which your mortgage goes along with it. And if you need some insurance to close that loop, then the insurance is a secondary part of it. So why would you go to another brand? Why wouldn't you just use Tom's brand or the brand of the group that sold you the house? And actually what you want for your insurance then is the simplest, easiest way to buy a decent product. And because you don't really understand what you're buying, you want some confidence that you're buying the right product. So, if Tom can put two products in front of you and say, here's a couple of products you could choose from, but maybe choose A because we think A is the best product, everyone's just going to go, fantastic, let's just choose A. That we in digital partners, we didn't really get to that quickly enough. So we tried a few things with Cover Genius, for example, but with hindsight, we should probably have backed them or somebody like them in a really big way.
Although it's interesting that, because let's say, especially from the insurance industry, there's the same experience, let's say, with financing cars or car insurance. So if you see the big banks of the car manufacturers like Volkswagen Bank or etc., they are huge, earning an enormous amount of money, and there you have exactly the same, selling the car and then also selling the loan of the car, which is quite interesting. So it's even in the sector itself, or in the industry itself, you have in another way exactly the same topic. And on the other hand, the loyalty of the customers is always a correlation with a specialization. If you do everything, we also had a podcast with Bought by Many, Stephen Mendel, so it would be interesting also to put him in the show notes. And there we asked the question, did you ever consider to change your name? Because let's say it's so clear that this will be the global pet insurance, at least they are going for this, that I'm pretty curious if in the end they will change it, because probably the loyalty will be totally connected to the pet.
So yes, and if you look at in the US, they trade under Many Pets now.
Yeah, I know.
Many Group. Yeah. So Stephen and I actually had this conversation over a beer, and Stephen said, the problem is that you build a brand and you invest money and time and effort into that brand, and then if you want to change that brand, then you need customers to follow the change, but that requires customers to interact with you every day. So if you're if you're a big high street retail bank, you could probably do it, because if your bank changes their name, you interact with them enough that you're going to remember the new name. Apple could change their name, and I would still carry on buying from, what are they going to call themselves, orange or pear or something, some other type of fruit. But if you're bought by many, I think the worry is that you then lose customers.
I don't think so.
So I mean, I don't know. I think it's a
especially in the long run, if you want to be a global brand. Like a little bit also in the old industry, like AXA did when they bought. It's always very clear that you have a certain phase or time where you have this double branding, and especially if you enter online, it's not so difficult. And then, let's say a couple of years later, you can just change to the new one. But I mean that perhaps it's a very specific question. But if you know that your advantage is in a kind of specialization, then to my point of view, it makes very much sense to put your specialization in the brand if this is your long-term strategy.
Yeah. So I don't disagree with you, although, and maybe it's a question of timing. I mean, do you need a global brand? I would say no, not really, because your customers are not global. Your customers are individual pet owners, and some people do emigrate, but that's a very small portion of your customer base. On the other hand, do you want to run multiple brands around the world and try and keep them up? No, because that's inefficient. And the world's increasingly global, at least social media and so on. And I wonder whether the answer is it comes to a point in time. If you're Stephen Mendel doing it now, you say, well, changing my UK brand carries risk. That risk is large, potentially even existential for me, because my UK business is by far the biggest part of my business. In 10 years' time, probably Stephen's US business will be his biggest business.
Yeah, sure.
And actually, in 10 years' time, Many Group, as I think it's now called, will be a large global pet health business, not just a pet insurance business. So his UK pet insurance business will be quite a small proportion. And maybe at that point, you can do the sort of AXA thing of saying, well, let's just have one global brand. And his UK insurance sales might have a small hiccup, but it won't really matter. I think the question is whether is when you do it. But it is fascinating in that his original brand made perfect sense for his original business model, but
Not
business
for the
models
current
change, and sometimes brands survive the business model.
So maybe I initially wanted to ask about embedded insurance. I'll park that for now, but I'm going to make time. But maybe one thing that I think fits more into it is what I've observed is, or I recently listened to a podcast of a very successful InsurTech founder, and he explained to me quite an interesting numbers, and I just number one, whether these numbers are correct, and if you could explain them to me, and he said a lot of kind of InsurTech carriers are trading in the private or public markets at gross written premium multiples of, let's say, 5 to 10x or something. If you compare that to traditional insurance companies who usually don't even use those metrics, right? They trade on different on different metrics, but it's more like 0.25 to 1.5x. So first question, is that even accurate? Or because I didn't double check. I'm not a financial analyst. I don't have that information. So is that correct?
Yeah, yes, more or less. Yeah.
And why is that, you believe? What is what's the reason for that difference in both groups, and then also within the InsurTech group, in your experience?
So I mean, if you look at there's two questions in there, right? The first is you have to compare public market and public market. You can't compare private and public. So to deal with that, first of all, in the private market, your valuation is set by the hungriest investor. The fund that's willing to put up the most money or the highest valuation is the one that gets the deal, and they set the valuation, and there is no seller. Whereas in the public market, for every buyer, there has to be a seller, and that sets the price. So inevitably, your public market price is the average of buyers and sellers, and your private market price is the price of the buyer, so it's higher. Within the public market, though, I mean, there are not really enough quoted InsurTechs to have a really compelling thesis. But I think if you do the maths, and if you take the InsurTech's growth rate over the last year, and you assume that another sort of 4 or so years of that growth are priced in, then what you end up with is you end up with multiples. You end up with the InsurTech multiples being not that different to the public market insurers, and it seems to me that's a reasonable thing to do, because if you're buying, a Lemonade or a Hippo, the one thing you can be confident of is that these companies are going to continue to grow very quickly, over the next 3, 4, 5 years. The reality is none of these InsurTechs have a material market share compared to the big incumbents. So they've grown extremely quickly for the last 5 years. They'll carry on growing extremely quickly. I think the harder question then is where do they land? If you look at the valuation, of a sort of very traditional incumbent like an Allstate, and you compare that to a valuation of one of the golden companies like a Progressive, there's really quite a big difference between those two. And I think the big unknown in InsurTech is, after 4 or 5 years, however long it takes until the growth rate is normalized. Once the growth rate is normalized, are you going to look like an Allstate, or are you going to look like a Progressive? And eventually, that's going to come down to margin.
Yeah.
My sense is that public market investors tend to be, a little bit more cautious, maybe a little bit more savvy than private market investors, which is partly back to the way public market investing works compared to private market investing. I was involved in a process in Bought by Many's last round. I was advising one of the losing funds, and they were taking an extremely sophisticated look at the business, and their view of the right price for the business was a bit less than the price EQT paid. Now, I'm not saying that they were right or EQT was right, but eventually nobody cares what price that they thought was right. The only reference price is the price that EQT paid. Whereas in the public market, those two voices are equal, because one is a buyer at a certain price and the other is a seller at a certain price. And so that gives the ones who are a bit more cautious or a bit more skeptical sort of more of a say in how the price is set. So my sense is what's happening in the public markets is a sort of skeptical questioning of whether these businesses will hit underwriting profitability, and if they hit underwriting profitability, will it be at the Progressive end or at the Allstate end? And honestly, I think that's the question public market investors ask me most often, and my answer, company by company is, I don't know, but here's the things you need to worry about.
Yeah. What are the things you need to worry about?
So, I mean, take let's talk about two then. So Hippo and Routing. I'm not making predictions, but those two are ones with question marks around them. Routes pricing clearly needs to rise. They know that, and they are raising price. And the question is, can they raise price and retain customers? Mm-hmm. Lemonade did in their renters book. Big question whether Route can. If Route can, then they're going to be very valuable. If they can't, then they're going to fall off a cliff. And so that's, again, as a public market investor, you also think about risk, and is there risk in that? Hippo, it seemed to me, are extremely concentrated in some high risk states where you have severe cat events. Those cat events are getting worse. All of the research from the big reinsurer says those cat events are getting worse and worse. And Hippo seem continually to say to the market, well, we got hit by an unexpected event. Well, eventually you've got to start expecting the event. And then the question is, can they move their book from being one that's concentrated in those high risk areas to one that is really across the whole of the US? Is there a business model that works? Is their model efficient enough? The home insurance market, it's not as bad as the prime auto insurance market, but it's pretty competitive. Mm-hmm. So, can you? Is there a business model in there that actually works? And frankly, will their investors give them time enough to build it? And I don't know the answer to either of those.
I mean, we don't have a crystal ball, but I think it's interesting, right? And I think it's showing that obviously you need to have a detailed look at these things. But no, I think that equation of it's about growth, it's growth about the next 5 years, that continuation, if you then compare those, then the gross written multiples, that at least, in my kind of, bachelor and master's educated mind, that makes sense, right? I can square that circle. That's fine.
And I think that I'm always wary about betting against these people, because it's a very steep pyramid, right? There are an awful lot of startup entrepreneurs who start a business and either get nowhere or get somewhere, but don't get very far. I mean, one of the companies that I really love is WeFox, and they were never a company I partnered with, so I only ever saw them from the outside. But my question always with WeFox was, does this work outside Germany? Because if it works in Germany is a huge market. But if it works in Germany alone, then you've got a cap on the valuation, and each time they raised at a larger and larger valuation, I kept looking and going, okay, but where's the ceiling? If this is just German business. And then someone told me that they'd taken over a broker in Italy.
Yeah, Mansuti.
Yeah, and had increased its productivity by an absolutely absurd amount. And so all of a sudden, then, my ceiling on their valuation has just gone up, because if they can do it in Italy, they can do it in Spain. And if they can do it in Italy and Spain and Germany, then they can do it in the UK. And if they can do it in the UK, they can do it in the US. And all of a sudden,
it's very complicated.
It looks like it's undervalued. And I think my point is that even when you're a little bit skeptical about these businesses, I'm very hesitant to bet against them, because they are run by some very, very smart people.
Yeah, but let's say if you just zoom out and just take private equity in general, and you see there's just too much money, and you take just other business models like gorillas and all those people who are delivery services or all those small steps flying around, etc. You just see that there are a lot of stuff which is funded because there's just too much money around, and those funds have to invest, and there's enormous pressure on investing the money. So I mean, you can have a very detailed discussion about certain InsurTech investments, and then you zoom out and take the same sector, and you see a lot of stuff where you just know, how will this ever work? And that's for historical reasons. You have those phases again and again, where there is, yeah, you can go back to the 17th century and the tulips in the Netherlands, or you have those phases again and again, and then at a certain point, then the multiples are just too high, and then you have crisis, and then I mean, and for internet, it's not that long ago, at the end of the 90s, and the question will just be, when will there be this crash? We don't know yet.
I mean that's right. I mean, and I think the InsurTech did suffer from being the golden segment, the golden sector that everyone wanted to invest in. So there was a lot of money going to bad companies as well as good companies. I never felt that there was a valuation bubble though in InsurTech, the way you've seen in some sectors. You know, I'm old enough to have been around in the dot-com crash, and there was an online toy retailer whose name escapes me, but they didn't survive very long. But at one point, their valuation was only defendable if you assumed that they could have that they could get 25% of the global toy market. And you know, if you look at Toys R Us at that point had 1% or 0.1% or some vanishingly small number, and it just seemed
Probably e-toys.
Yeah, there were just these insane, potentially good companies, but just with absolutely insane valuations. I've not really seen that in InsurTech. I think valuations when they were at the sort of 8 to 10 times premium, it's these can be great assets. They're not necessarily great investments at that. You know, that's a full price, but it never struck me as an insane price. I mean, I mentioned Botwemeni's last round. I've no doubt that that Stephen was very happy with the valuation he got to, but that valuation was not a million miles away from where I'd got to, or where the firm that I was working with had got to. I do think we are now in a different world, though, as regards InsurTech. I think perhaps because of the skepticism around some of the ones that have gone public, there is a bit more caution about with InsurTechs, and that makes it a little bit more difficult to get funded if you don't have a really great proposition. But your basic point, I think, Tom, is still right. There is still, in every sector, there is still a vast amount of money around and not enough places to put it. So valuations are going to be high in everything.
And especially if you expand abroad, then the complexity also grows. So if you, let's say, only do payments, like RDN, for instance, does, then you can really say, okay, these are global markets. But if you have to manage a company in 50 different countries, like for instance, if you're also, let's say, buying brokers like Refox does, etc., you get enormous complexity, and that's a totally different game. So let's see what happens. But I think at least you were probably the first who entered the space with digital partners. So I think it's you shared a lot of interesting insights.
Yeah, and certainly we did discover some of the complexity of doing things globally. Like everybody else, we tried and failed. I wish I had my time back, so I would just say I'm just never going to go to China.
So just kind of looking, conscious of time. Unfortunately, I think we'll have to park my question about the embedded insurance playbook, but there will be, I'm sure, other ways to exchange ideas, Andrew. I guess to kind of wrap this up, is there anything our listeners can do for you? You know, I'd like to ask, you know, who should contact you and who shouldn't? Because I don't like to be contacted by everyone, but just anyone personally.
Yes, just not everyone. So, well, what am I doing? I'm doing some advisory work around InsurTech. So, you know, if you're a large incumbent, you're looking for help, then I do a little bit of that work. I sit on the board of some InsurTech and insurance companies. So, you know, if there's an opportunity there, then I'm always happy to talk. From the investment point of view, most of the investing I do these days is growth equity and private equity. I work with a fintech private equity firm called Munich Re Partners. So we are looking for fintech and insurtech businesses at a reasonably late stage, so you know, $20 million plus of ARR. Yeah, those happy to hear from those businesses if they are, you know, thinking about raising money.
Awesome, Andrew. This was, I mean, time truly flew. Thank you so much for sharing your insights. It was really good to talk to you again. And, you know, may 2022, you know, hold what you expect it to hold.
Thank you very much. It was a pleasure talking to you and worth the wait.
Yes. Thank you, gentlemen. Have a good one. Bye.